Hey, so welcome to the Spry Guys podcast. Why don't you join us as we cover some amazing topics around financial planning? The goal is to simplify and empower you as a client to build multi-generational wealth. So come join the journey.
Hey guys, welcome to this month's episode of the Spry Financial Planning Podcast. This is going to be a good one. Not to say dropping Granty is part of our plan, but we have got a replacement here today. Some would call it the bomb squad. But today we're super fortunate to have Philip Bradford fly down, and he's going to sit in our podcast and we're going to have a bit of a chat and get some insight into Phil's role at PortfolioMetrix and the value that he adds there and to you as a client. Welcome, Phil.
Great, thanks for inviting me.
Yeah, absolutely. So, Phil, you are at PortfolioMetrix. I'll give a bit of a spiel, a bit of a background. You've been in the industry for quite a while, ranging from what we've been chatting a little bit about through Investec, Absa, Sasfin, now at PortfolioMetrix. So a couple big names in the industry. Maybe just give us a bit of insight into that kind of journey that you've been on to get to where you are today in that sense.
Yeah, great, thanks. I mean, it's coming up on 25 years in December now in the market, so it's been a long time, and it's been an interesting time too, because the markets and what's available to us nowadays has changed so much over that time. You know, in those old days, in the 90s and the early 2000s, you could only really invest in what was on the JSE, and what was available to you was a lot less. Where nowadays, the world is a oyster. We can very easily access almost anything around the world for investors out of South Africa. So I've seen it change a lot, and I've learned a lot working in those different companies. I've worked as a bond and interest rate trader in the bank at Investec in the old days, and then the asset manager. But I've also got to see, different styles and themes and trends.
Yeah, I can imagine.
In the old days, everything was about value, and then it was about something else. And those things have changed, and we've kind of got to, over the years, you get to learn what kind of works and what doesn't, and also not to get caught up in the latest sort of hot trend.
And that's difficult though, just to get not caught. I mean, even in the world we live in now, especially, that's magnified. Everything's topical. Access to information, right? That's at your fingertips. You got X, not Twitter, but you've got all these different mediums, Bloomberg, everything like that. I know they've been around for a little bit longer, but you are just bombarded. We spoke a little bit earlier around emails, right? Like you are just continuously hit with emails and information overload sometimes. I mean, that's probably a skill on top of your other skills, but that you've had to learn to navigate, kind of filtering through what is important, what isn't important, and I can imagine.
Yeah, 100%. I think particularly with the advent of social media now, a lot of information that would never have been accessible to the man on the street, they're now getting bombarded with theories around investing or cryptocurrency or this, and learning things that you otherwise would have had to learn out of textbooks and the like. So I think as investors, one of your biggest challenges is filtering out what doesn't matter, which is probably 99.9% of it, and understanding what does matter. And then also the kind of the art of investing is not trying to like forecast the next best event or find the next hot stock. It's actually the opposite. It's actually kind of the next level down and doing more insight into how much something is worth and where can I generate the best returns. So it really is the nowadays, I think particularly for the end investor who's not a professional investor, it's really difficult because you're bombarded with all these experts or social media experts who just sending you things, and it's very easy to get caught up in that, by the way, as an investor, particularly when you're younger. When I started in 99 going into 2000, it was just before, it was the back of the dot-com boom, and everything was around
Just dynamic time.
Price to earnings don't matter anymore, and tech stocks are the next best thing. And those same stocks that crashed in the end of 2001 took 10, 15 years often to get back to their values again. So the trick is not to get caught up in those trends and to just stick and understand what really works over time.
And I think at Sage, it's a great point. You mentioned, like, when we're talking about the information overload and trying to digest the information in terms of what is a good investment, what's not a great investment, and people being bombarded through social media, which ironically, this is going to go through on social media, but and it's a bit of information. So, but the thing there though is what I also think about sometimes is everyone in their own job is also bombarded and overwhelmed with information around what to do. Like you think about doctors as an example, or lawyers, and all the legal opinions and research papers that are being thrown around left, right, and center. So not only are we as individuals in our own kind of spheres, our professional spheres, bombarded with information there, but when we want to actually invest and diversify away from our profession and on the investments side, there is just so much information. So that's tough. You mentioned like the finfluencers that they like to call them. I mean, I'm not anti guys on social media helping, but what is your opinion there? Or maybe not what is your opinion, but would you agree or maybe disagree that guys should potentially take that advice with a bit of caution, because
Yeah, I think, there's an old adage that says, free advice is often the most expensive. And I think anyone that's online offering their opinion, it's probably just that. And one of the biggest challenges with investments, I think, is that your opinion doesn't influence the price of an investment or what's happening in the world. So, you really need to understand like actually what's happening. And I mentioned it earlier, but I often think of financial markets a bit like I think of a Rubik's Cube.
Yes.
Because they're interlinked. What happens in America in their equity market or their bond or fixed interest market impacts what's happened everywhere else. And so the markets are kind of interlinked like that Rubik's Cube, and you might try and fix one side and you mess up another. So you need to understand what's kind of happening. And really, again, probably the art of investing is really about engineering a portfolio and putting it together so it's in some sort of harmony, so that you don't end up with massive exposures to one area or the other. So the human nature is such where people want to find that next hot quick
100%.
buck idea.
Yeah.
We all deep down, it goes back a million years of evolution. And the problem is that is the exact opposite what you want to do as an investor. You actually need to be more conservative and not get caught up into trying to make a quick buck. And actually by putting all the right investments together, diversifying effectively, that's actually what works better. It's not about being boring and getting a worse return. It's actually about being boring and getting a better return.
But I think sometimes I come across the situation that's perceived as being boring, and that the kind of, I don't want to say standard, because it is so complex and it's so like rich in its sense itself. So I don't want to simplify it and discount it to some degree. But the opinion is that stock standard boring approach, that's not for me. That's 2-3 generations ago. That's not how it works in this world right now. And sometimes I just feel like we got to push back against that. And actually, there's a place, don't get me wrong, there's a place to speculate to some degree where your planning makes sense. But I find that the value for clients is what I've seen over my 13 years in the industry. The value for clients is having that astute, well-suited plan, ticking the boxes. The results are actually a lot better for clients. Yeah. That's just what I've seen.
I mean, a good investment strategy is probably like a good business plan. A good business strategy, it guides you for the long run as to where you need to go, and you might need to change around it over time, but you can't flip-flop and change all the time. That's when that's when you destroy the most value.
Exactly.
So it's really about getting that long-term asset allocation in place. And what that really means is getting as much exposure to sort of the best companies and the best investments around the world, but being sufficiently diversified.
Yeah.
What's powerful about that, though, is that you end up with a smoother kind of return over time, but more than enough return.
Yes.
But most importantly, when you do get a big disconnect or a sell-off in markets, you actually can take advantage of that.
Yes.
And the very nature of human nature is to try and take too much risk or none at all.
Yeah.
And actually, it's the in-between that works the best. So the good boring strategy, if you can grow at 10% a year, that's actually better than most stock markets do on average over time. But people think 10% is not enough. But actually, if you grow 10% a year, you'll grow enormously. But the other thing as well is I think often investors that have, let's say, 1,000 Rand want to turn it into 1,000,000 Rand. But that's not, investment markets are not going to do that for you. Markets will take what you have and grow it into something big over time. But they're not going to make you rich quickly. And if you try to make yourself rich quickly, that's when you tend to lose it all.
It's such a good point. It's such a good, and I think it's understated to some degree, because you cannot, I say this to clients all the time. Of course, what we want to do is we want to get the best return for clients. I mean, that goes without saying. We want to get the best returns where they are suitable for clients. But actually, that's not what you can create wealth over long term in that sense, but getting rich overnight or creating that kind of stupendous wealth in that sense, you got to do that in other ways first sometimes and create that, and then let that gear or let that grow and go from there. Yeah, it's good sage advice. Quick one before we go into kind of the PMX side of things. What is the first stock that you can remember buying?
Well, I think one of the first I bought was probably Dimension Data back in the day.
Yeah.
Rode it up and down, I think. Managed to eventually make a little bit of money out of it, I think. But that was a perfect example of the back end of that tech boom.
Yes.
You had these hot stocks that you would jump on, Data back in the day. And actually, what I've found over time is my best investments have been the sort of the meat and potatoes kind of stocks when I bought stocks. By the way, in general, I find buying individual stocks, and I'm a professional investor, is a terrible idea because you get caught up in the hype of this stock or that stock or the news. Mining stocks in particular are incredibly volatile. And when I've looked back over time, it's actually been the investments that I didn't think were going to do incredibly well, I thought were going to plod along, that have actually done the best.
Surprised you.
Where mining in particular is very volatile. So I did okay out of Data, I think, but I also managed to get out before it fell from 100 Rand to 1 Rand, or whatever it was at one stage. But yeah, that was a good example of what not to do actually, and I suppose I was lucky to get out when I did. But yeah, I think I totally avoid sort of the share portfolio nowadays. I focus a lot on bigger asset classes and just getting that right plan in place. And it's amazing how, you look back after a few years and it's actually grown fantastically well. When I look back at the old share portfolio and you think, oh my gosh, what was I doing back then? And it's behavioral lessons it's textbook behavioral lessons about what not to do, really.
So the behavioral side is huge. I think we were researching the other day, and I can't remember the company, but it wasn't Goldman Sachs, but it was one of the guys where they came out with a paper that the behavioral side can reduce an investment on average by 5% a year, investor behavior. So it's significant, and you get caught up in, like you said, the thematics of it. I know South Africa is going one direction, GNU, everything, a rising tide lifts all boats, like let's just buy anything. Not always the case when it comes to like single stock sides of things, high conviction. So
yeah. So when we invest and do the asset allocation, do a lot of the work ourselves, and in certain areas we outsource to specialists. If we're looking for a top stock equity manager, as an example, if we hear that it's all about concentrated bets in this stock or that stock, we run away, run a mile, because we know that over time that will actually destroy them. A lot of it again is about engineering a portfolio, putting the construction of the portfolio together right, and then that comes through over time. So I think you've got to be very, very careful about people who are trying too hard to win from an investment perspective.
Yeah. Fear and greed, eh?
Yeah.
Sometimes
The other thing as well is that you actually find that the financial markets have a lot of these like sentiment indicators about what people are thinking right now, and you actually find the US market's got some great examples of this. Is actually when the outlook is the worst is the best time to invest, and when everyone's super positive is almost the worst time to invest. And it's pretty logical in a way. People who invest in property and the others think, no, gee, if I can buy a good property in a time when there's just been a fall in property prices, you're going to do that. And buying into things after they've gone up is the challenge. The problem is your brain and your mind is telling, and your emotions, particularly with your own money. But behaviorally, 100%. I think as well, when for any investor who's looking to invest over time, they've really got to understand not only their own personal attitudes to risk, but it's their willingness to take risk, but also then their ability to take risk. And you've got to marry those two.
100%.
And often investors, they've got an enormous ability, they've got lots of money, but they don't really want to take risk. And the trick is not to be in a situation where if markets do fall, and markets fall all the time.
Yeah, it's part of the cycle.
In fact, if you look at the US stock market, the average drop in any given year is 13%. So at some point, on average, it's going to drop. So the trick is not to jump overboard from the ship in the middle of the storm, and to be able to take that. So if you're taking on too much volatility, too much risk, then then the plan's not right for you. So it's about getting a plan, a strategy in place that is suited for you personally, both in terms of your willingness and ability to take risk. And then designing, that's where we come in, and we build a portfolio that is suited for that specific investor to help achieve their objectives.
Yeah.
Not too much turbulence and not too little as well. Because if you don't take any risk, you're not going to get anywhere. But if you take too much, you can end everything.
So, but that's a big point as well that I was about to mention, is if guys also become too conservative, clients become too conservative, we've built up this wealth, and I found that our industry has done well to move away from that. But I know when I first got in the industry, a lot of the thinking was, let's build up or accumulate this wealth, and pre-retirement, get to retirement, I built up this nest egg, 10 million, 20 million, whatever the figure is. Now suddenly de-risk. I must be conservative, and I must just protect that money. I understand the psychology of it. It makes sense. Like the ability for the client to then go and recoup that loss, or in terms of generating an income to supplement that, is difficult. But you have longevity risk that you got to worry about, which is a very real risk for clients. Now, guys are living for a lot longer. You're looking, I mean, we plan for 25 to 30 years post-retirement kind of situation. And that's just the general ruling. Obviously, then we take into account our clients' kind of family history and those sorts of things. But you got to look at inflation, medical inflation. I mean, one of the big players just came out, their 2025 rates is a 9.3% increase on average. So if you factor that in on your plan to only have an escalation on your income of 6% as an example, because that's what Stats SA has said CPI has been, which is not incorrect, and then you've become too conservative as an investor, you're going to be under pressure, right?
Yeah, I think it's in investing, it's as risky to take no risk as it is to take too much risk.
I love that, yeah.
The analogy I often give to people is driving from Joburg down to Durban as an example. If you go 40 kilometers per hour along the highway, it's probably more dangerous than going 100.
Yeah.
Because you've got trucks overtaking you, and you're also never going to get anywhere on time. If you go too fast, if you're going 200 kilometers an hour and something goes wrong, as it normally does, you hit Van Renen, or you or there's someone burning tires on the road outside Mooi River.
We're a dynamic area.
You're in trouble. Okay, so it's really about finding that balance, and there's a safe speed. And then really what it is changing it, as the outlook sort of improves, if there's mist on the road coming up ahead, etc., you can see it coming, you can sort of slow down, and then when the road opens up, you can speed up again, but always keeping in that sort of balance. The other thing I think is investors often think that they either have it in no risk cash, or they think stock market super risky. Actually, the best is somewhere in between the two, and your easiest returns to get are the first kind of steps out of cash. You can normally add 1 or 2% quite easily with almost very little extra risk. But investors don't really know that. So they almost think binary, no risk or risk. And they also think that risky means lose all your money. Where actually in markets, very, very risky, 100% in the stock market, a pullback of 20%. Is a crash, okay? But that normally recovers again over a period of time. In between that, if you've got lots of different investments all over the world in stocks, bonds, property, across 50 different countries, like our portfolios tend to have, you're diversified across 7,000 different companies and bonds and the like. You actually got the chance of you ever losing any money, let alone all of your money, is very, very low. So really, I think from an investor, those first couple of steps out of cash is the best returns you can have, and that's probably like traveling 100 kilometers an hour along the highway. Not too fast, but not too slow.
This is I love these discussions with guys like yourself, because we get the best analogies. We get to extract those. I mean, the car with the mist, it's brilliant. It's absolutely brilliant. But it is that. I think you mentioned client suitability. I know in our industry there's a big push from a regulatory perspective around managing client suitability, managing the investments relative to client suitability, and I'm all for that. I mean, you got to understand what each of us are trying to achieve. We investors in our own right. What are we trying to achieve? What are our risk tolerance? What are our risk requirements, and so on and so forth? And I think that's where there's so much power in having a plan.
Correct.
And having a plan that ties into a portfolio selection that can increase the likelihood of you achieving those objectives. So earlier you mentioned that, okay, maybe you're not going to shoot the lights out every single year, and you're not going to have these massive peaks or troughs, let me put it that way, but you're going to have a more predictable kind of journey. And that actually, from what I've seen, is, in my opinion, that's potentially better for clients, because it reduces or inhibits the client's investor behavior. So their reaction to markets.
Correct. Well, it's two things. First of all, behaviorally it's better, so you're less chance of making mistakes. Secondly, actually it produces better returns over time.
Yeah.
And this is quite a hard thing for people to understand, is that actually by taking too much risk, you reach a point where too much risk hurts your returns.
Yes, yes.
But this is also where having a professional advisor assisting you is getting that plan together. So I've got friends who are CA, CFA, they're trained, but they don't actually know how to put an investment portfolio together. They don't know how to plan. Because very often for a private individual has multiple different types of investments that are required. It's different time horizons. It could be your pension fund. It could be the pension fund when, if you've got a lot of money, it's for your grandkids potentially. It's those sort of things require a different risk and focus than it does for your money that you want to spend in the short term. So you need someone to actually help you put this together in a way that actually makes sense. And then build these different strategies that apply to you personally. And it's not just, again, about like going and finding the next sort of hot idea from an investment perspective. It's actually about putting a proper strategy in place. And that's kind of where we come in as well. We work with professional advisors like yourselves. We're PortfolioMetrix is probably like the best kept secret in a way, because we're not really known to the man on the street, because we're used by professional advisors like yourselves to help build portfolios for your clients. And build things in a way that makes sense to each individual, rather than trying to buy something off the shelf that might or might not suit you.
Might not be suitable. No, I agree. I mean, I really enjoy, like, when you speak about the engineering and the science and all that. It's all on purpose. Like the way the portfolios are structured, the way that they relate to the specific client, the technology that goes in behind that. We really enjoy that side of things. Phil, maybe if in your role, you're head of investments, and I know we've kind of tapped into this a little bit, but maybe to give our listeners a bit more insight. So Phil is head of investments at PortfolioMetrix, and you've been there for a little while now. PortfolioMetrix obviously having locations in South Africa, in Ireland, in the UK. So you got that presence. We speak about boots on the ground earlier, or having those specialists. You have that, for your allocations, your domestic funds, but your offshore allocations within there, you can lean on your teams who are based offshore. But maybe if I can bring our listeners in terms of, and I know you've lent into this a little bit, but PMX's investment philosophy and kind of how you guys position yourselves. Maybe if you can just shine the light on that a little bit for us.
Yeah, I think it's partly about learning from over the years about what doesn't work and then what does. And it's all about efficiency and providing consistent type of returns. Like I said, the world has changed from 25 years ago, where you had to build everything around the stock picks. Now it's actually, we've got so many instruments and types of investments available to us that we build these like proper asset allocation portfolios, where someone sitting in South Africa is able to, whether it's 10,000 Rand or 100 million Rand, actually is able to get access to investments all over the world. So it's really the whole start of it is we engineer these portfolios. Asset allocation is our suppose our secret sauce in a way. And what that really means is about how to combine all these asset classes and investments around the world in a way that works. You could think of it almost like it's, if you're a top chef, it's not just about the ingredients; it's how you put them all together.
And bit of art and science.
Well, exactly that. And we use the term engineering because engineering is actually kind of part art, part science in a way, and it's better than both, because there's not some sort of little formula you can take off the internet. It's actually a markets are dynamic, and you need to be able to manage these investments over the long run. But it's really, again, having understanding where the world has come from, and we've moved to what's available to us now as investment managers is so broad. So I get involved in the whole asset allocation process, right the way down to managing local fixed income and bond type portfolios. And we're in a very fortunate position because we're not stuck on one particular style or one particular asset class. We actually get to meet with hundreds of managers around the world. So when we put a portfolio together, it's not only our team. We are able to outsource certain components of that portfolio to super specialists in their markets around the world. And in other areas, we'll just go and use passive and cheaper ETF
where
type
it makes
things.
sense.
It's all about what's the greatest efficiency. So it's really, and efficiency comes both in terms of returns, and consistency of returns is the outcome we're after. But then also cost-wise, we can do things nowadays so much cheaper than it used to be in the old days. So it's really fantastic now, whether your money's sitting in South Africa or whether it's sitting in Guernsey or Ireland or the US, you can actually have the same kind of exposures, and you can do it very, very effectively. So it almost doesn't really matter where you sit in the world anymore. We can access that out of South Africa. Where in the old days, you weren't allowed to take your money offshore. So you could only really invest in a couple of stocks on the JSE. So now we've got this, the world is our oyster effectively. And from a philosophy perspective, again, it's about engineering the portfolio to provide a consistent, efficient outcome. And that smoother ride actually provides better returns in the long run.
Yeah, and I honestly fully agree with that, because I've just seen it. Like, I go back to the behavioral side. I just think it is so important, and not to sound like a stuck record, but I've just seen it all the time. It's so interesting where you talk about the advent of technology and the ability to create efficiencies within portfolios and access to different vehicles. There's no reason for guys not to live in the best country in the world, like South Africa, and access different portfolios and different asset classes all around the world. So come on, GNU. But so it's really exciting from that point of view. And I love the depth that the team goes into, the access to that data, and then obviously the filtering through and pushing out of that data to end users like ourselves and our clients in a manner that is digestible and practical and actually useful in that sense. It's not just to... Sometimes I wonder, some of the information can be overwhelming and more egotistical in the sense where it's like, look, I've done all of this information. I've done all of this research. Here's this information. I sound clever. And if we can avoid that and mitigate that, and our client can sit across the table and be, you know what, I might not understand every single thing today, but I'm one step closer to having a better grasp on what's going on, and I have a lot of confidence in the portfolio.
I think the temptation is always to feed information or do presentations that's exciting and interesting. The US election or Middle East or something else, or complain about something in the politics. So, but what the media does is they do what they call infotainment, and I'm talking about Bloomberg and CNBC. Never mind the clickbait news. They literally will tell you when I've been on a lot of those channels a lot, being interviewed, and they say, we're about infotainment. We just want to keep people eyeballs on the screen. Where actually as investors that hurts you, because it makes you stress and panic about the wrong thing. So my job and our job is to manage those risks so you don't have to worry about them. So when Russia invades the Ukraine, it's interesting, but it's actually not going to hurt your investment portfolio dramatically, or even better, you can take advantage of it. So my job is to worry about that, so investors don't have to worry about that.
That's good, and I think because what ends up happening is you have, you alluded to earlier recency bias, but you have that, and all of these things. Sometimes the investor feels compelled to do something. We're like, if I don't do something, then something's going to happen. But the way that PMX structures the portfolios from our discussions is that obviously you set up in a way to take advantage of a diverse range of outcomes, and not necessarily a binary approach in that sense, which speaks to loss aversion and so on and so on and so forth. Loss aversion, sorry. It's interesting.
And in fact, a good example, by the way, is we've got one of the with the US election, the previous election that Trump won 2 elections ago
against Hillary.
So the market the market narrative at the time was that Trump was going, if Trump won, markets would crash. And the polling data and the odds were actually saying that he was not going to win. Like literally up until midnight South African time, I remember going to bed and there was no chance that Trump was going to win. It was kind of 60-40 almost. He did win. And markets not only didn't crash, but they went up 30%. So you've got to be very cautious, not only about, you could have forecasted perfectly that Trump was going to win. No one else believed you. And if you had positioned accordingly to that, you would have shorted the market
100%.
And you would have lost a fortune. So as an investor, you can't get caught up in that sort of noise. So I've learned over the years behaviorally to actually get excited when markets sell off, because I know we positioned well to be able to take advantage of that, rather than get stressed about it. And as an investor, you've got to shut out those emotions and rather take advantage of those. And it's not easy to do.
It's not
taken
easy.
many years of hard-learned lessons to be able to do that.
Lots of school fees. It isn't easy. So we're not sitting here saying, oh no guys, just do that and being flippant about it. It is difficult. It's still managing human, like you said, human emotion. It's managing that all the time. Phil, just in parting, from your point of view, what key takeaway, and maybe you've alluded to it already, but what key takeaway would you encourage our listeners, our clients to kind of leave from listening to this, to leave and go forward?
It's more of a summary, I think. You need to get that plan in place. You need to understand a lot about, not only about yourself behaviorally, but what you can afford to do. So both your ability and willingness to take risks. You need to put a plan in place, like a business strategy, a strategy. Okay, this is what I need to achieve. I've got this amount of money. This is what I can do with it. This is my tax. This is my story. This is where I want to live. I've got some money overseas. You need that plan, and that's where, like a professional advisor, helps you put that in place. And that's when then we come in and we help and build often multiple portfolios that actually help achieve that. But it's very, very hard to do that on your own. And it's not going to, in order to do that, you really need to understand of what is available out there in the world. And nowadays there are not only tens of thousands of stocks, there's tens of thousands of indices and ETFs.
All the different instruments you got.
So the world has become more accessible, but similar to information, there's just so much out there. So you really need someone to help pull that all together. But if you've got that strategy and that plan in place, then you should be fine in the long run.
Most of your battles won.
And that strategy is designed for you to not only achieve your goals, but also make sure that you're not going to lose it all. And I find particularly investors, particularly as you get older and you've accumulated wealth, the most important thing is don't lose it all. And that strategy is designed not only for that to not happen, so in other words, for you to do consistently well over time, but to be able to not have to worry about those things. And when you take that worry off the back of an investor, then they don't make those emotional errors. So put that plan in place, use your advisor, help them put that together, and then again you can worry about other things.
But it's the one thing that we maybe haven't touched on is we've spoken a lot around structuring and selecting the right portfolios and the plan and so on and so forth. But it's also that continual oversight, which I really like. So it's not only okay, we put the plan in place and that's it, we'll see you in a year's time kind of situation. Absolutely. That's not what happens. It's just continual oversight and day-to-day management of the portfolios that are happening for the clients, which are massive.
I give me an example. Sort of 2 years ago, we took. It was just at the time when everyone thought SA stocks were going to take off. We took a lot of the money offshore at that time. And then everyone became negative on the rand, and Putin invaded the Ukraine, and things went out. And we were actually now starting to bring money back again. So you need to manage these things over time. Something shoots up, you need to reduce that exposure. Something falls dramatically, you need to increase that exposure. But that's largely just, you're still keeping in line with that strategy. So no, we are very much active in terms of managing those risks, and it's about managing the risks more than anything else. So absolutely, the strategy's in place and your direction's in place, but you still need to keep on track with that over time, and that's where we come in.
Amazing. Phil, thank you so much. Thanks for your
pleasure.
time. It's been amazing to have you here. We hope you guys enjoyed it. Hope there was some value that we added. I'm certain Phil added loads of value to everyone. We'll see you guys soon. Thank you so much for joining us on this episode of the Spry Guys podcast. It was so good to have you here with us. Don't forget, before you make any sorts of financial decisions, chat to your financial planner. He'll help you, or she will help you, make an informed and objective financial decision. We'll see you guys soon. Join the journey.